So, Chapter 3 covers financial statements, cash flows, and taxes. And the major learning objectives for this chapter are for you to be able to list each of the key financial statements and identify the kinds of information they provide to corporate managers and investors, and for you to estimate a firm's free cash flow and explain why free cash flow has such an important effect on firm value. And then I'll just have you read about the major features of the federal income tax system in your book. So, the four financial statements contained in most annual reports provided by a corporation are the balance sheet, income statement, statement of stockholders' equity, and statement of cash flows. The balance sheet shows the firm's financial position on a specific date, for example, December 31st, 2014. It shows each account balance at that particular point in time. It's like taking a picture or a snapshot right at that point in time. For example, the cash account shown on the balance sheet would represent the cash the firm has on hand and in the bank on December 31st, 2014. The income statement, on the other hand, reports on the firm's operations over a period of time, for example, over the last 12 months. It reports revenues and expenses that the firm has incurred over that particular time period. For example, the sales figures reported on the income statement for the period ending December 31st, 2014 would represent the firm's sales over the period from January the 1st, 2014 through December the 31st, 2014, not just sales for December 31st, 2014. So it covers a year's time span. And those are the main two, the balance sheet and the income statement. And actually the statement of cash flows is very important too. It reports all of the firm's activities in terms of its cash flows for financing, investing, and operating activities over a given period of time. And so it's important to see how the firm's cash was actually used over the last year. And then we have the statement of stockholders' equity, which just shows how much of the firm's earnings were retained out of its net income, because the other part that wasn't retained would have been paid out as dividends. The amount of money that the firm retains in retained earnings is made available for use for other projects that the company can invest in. So a company that has a lot of good projects to invest in will retain more of its net income in the form of retained earnings rather than pay it out as dividends. Firms that are large and more stable and have fewer growth opportunities would pay out more dividends than retaining earnings. So we have an example of De Leon Inc., and it's a snack food company, and they underwent a major expansion in 2013. So far, nobody has really been happy about the expansion. Some key things that they pointed out is that their cash position has become very weak due to the expansion. Their suppliers are being paid late, and the bank is threatening to cut off its credit. And the board of directors has said we've got to make some changes here. Let's take a look at their balance sheet. And let's look at 2013 on the right to 2014 on the left. So they had $57,000 in cash, and then they went down to $7,000. So that's how their cash position became more weak. Their accounts receivable pretty much, well, almost doubled from $351,000 to $632,000. That means that they haven't gotten paid for about, roughly $300,000 worth of stuff that they've sold. And then their inventory balance has dramatically increased from $715,000 to basically $1.2 million. The idea of doing well with a company is to sell your inventory and not necessarily keep it. So the expansion that they did not necessarily work, and selling a lot of the inventory, which is the product that they made, which is the snack food stuff. So their total current assets have increased from 1.1 million to 1.9. Their fixed assets are like their investments in plant, machinery, or land has increased. So this is because they did the expansion and they bought more fixed assets. It went from 491,000 to 1.2 million. And then they have more depreciation because they have more assets to depreciate. And then overall, you can just see that their assets, they doubled from 1.4 million to 2.8 million. And that's not always a good thing. The other part of the balance sheet is the liabilities and equity. So the whole thing is that assets, all the assets that we just looked at are financed by everything here, the liabilities, which is debt, and equity. So there had to be increases in debt and equity to be able to finance such huge increases in their assets. And if you notice, these totals down here are equal to the totals on that assets portion of the balance sheet because they have to equal each other. So if we look at accounts payable, this is them paying their suppliers. That is dramatically increased because, as we saw, it said that they haven't been paying their suppliers on time because they probably can't. And so that's increased to 524,000. And then their accruals, which a lot of them occur like wages accrue and taxes accrue, they have gone up naturally as a part of the expansion process. And notes payable are their short-term debt instruments, and that's increased by about $436,000. So we can see some of the portion of the increase in their asset financing is in notes payable. And then their long-term debt has also gone up to $723,000, so they issued more long-term debt to finance this expansion. Their common stock has remained the same, so they didn't issue any new stock, and they probably wouldn't have received a very good price if they had, because the market is viewing what they're doing as badly because they're analyzing the financial statements. And then retained earnings has decreased, so this probably means that they've had a negative net income, and that has reduced retained earnings. And so you can see how we get to the totals for liabilities and equity on the balance sheet. And again, remember that this snapshot was taken at December 31st, 2013, and then at December 31st, 2014.